Welcome to This Explainer. Look, have you ever bought a stock, watched it shoot up the very next day, and instantly thought, wow, I might actually be an undiscovered financial genius? Hey, we've all been there. Today, we're doing a documentary-style deep dive into the exact psychological traps that completely blindside new investors during a massive market rally. We're going to explore that highly dangerous intersection where greed, overconfidence, and market cycles collide. Let's kick things off with a pretty sobering reality check. A rising market artificially inflates our ego way before we actually understand how investing works. Just imagine this. You make your very first trade, and purely by dumb luck, the stock surges 15% in a week. Your brain instantly assumes, yup, I have a natural gift for this. You see, when the market is going straight up, practically any decision you make looks like a winning one. But here's the catch. Making money because the market is red hot is absolutely not the same thing as having actual financial skill. Section 1, the bull market high, or when everyone is an expert. Our journey into market psychology starts right at the absolute peak of the emotional cycle. We're talking about that euphoric high of a roaring bull market where fear just disappears. Suddenly, the noise is everywhere. You go to a dinner party and your dentist is enthusiastically pitching you crypto and small-cap stock tips. Random companies with literally zero revenue are doubling in a matter of weeks. IPOs are heavily oversubscribed, and your portfolio miraculously turns green every single day. In this intoxicating environment, beginners sincerely start believing that making massive amounts of money is just, well, an effortless hobby. The really crucial point here is that those rising prices create the ultimate illusion of skill. When the market is absolutely ripping upward, you could literally throw a dart at a board of stock tickers while blindfolded, hit a winner, and make money. But, spoiler alert, you aren't a genius. You're just participating in a massive upward trend. Yet our human brains are remarkably good at completely ignoring luck and cheerfully taking full credit for the rising tide. A strong rally essentially puts a temporary band-aid over incredibly bad decisions. Section 2. The easy money illusion and focusing on the wrong things. This overconfidence seamlessly feeds right into the easy money illusion. This is where the thrill of the chase completely replaces any sort of logical analysis. Beginners become entirely obsessed with fast returns and highly speculative penny stocks. They completely ignore the fundamental quality of the businesses they're actually buying. And honestly, it makes perfect psychological sense, right? Carefully reading boring corporate balance sheets and doing revenue analysis, that doesn't give you a quick hit of dopamine. But chasing a rocket ship emoji on a message board, that certainly does. The entire focus shifts dangerously away from building sustainable wealth and moves toward chasing an overnight high. Section 3. Leverage and social media, and the descent into gambling. As those early easy profits start rolling in, a highly dangerous psychological shift begins to happen behind the scenes. Beginners slowly transition from relatively safe, straightforward investing into aggressive gambling. Because they've made quick money in cash markets, they just assume they can multiply those gains. So what do? They start borrowing money from their broker on margin to buy even more stock, or they buy complex options that expire completely worthless if they guess the timing even slightly wrong. They dive headfirst into these tools entirely unaware of the massive hidden risks like theta decay, which is essentially a countdown clock silently eating away at your money every single day, or massive volatility swings that can wipe out an entire account in minutes. This rapid transition into pure gambling is aggressively fueled by something called survivorship bias. Think of it kind of like looking at the tip of an iceberg. You only see the wild success stories, the fast cars, and the massive profit screenshots promoted by financial influencers online. But what the algorithms absolutely never show you is the massive, hidden, underwater graveyard of blown-up accounts. You just never see the silent majority of people who lost their entire life savings chasing those exact same highly leveraged trades. There is this stark, almost dangerous contrast between your social media feed and actual market reality. While the algorithms are feeding you a constant stream of luxury lifestyles, making you think, hey, if everyone else is getting rich effortlessly, why not me? The hidden truth of the market is far less glamorous. Behind those selectively shared profit screenshots is a harsh, unforgiving environment filled with catastrophic hidden losses, brutal panic selling, and heavy emotional stress that honestly breaks people. This heavily curated, false reality leads to a toxic obsession with finding the next 100x multibagger. Retail investors push themselves further and further into extreme, concentrated risks. They completely abandon the idea of building diversified portfolios, and instead they start treating the stock market like a giant casino, endlessly searching for a winning lottery ticket. And in the process, they entirely forget that real wealth creation actually takes immense patience. Section 4, when reality finally hits and the inevitable correction. Because eventually, the euphoria exhausts itself. The music always stops, and the tone of the entire financial world shifts dramatically. The critical question here isn't if the market will correct, but how you are going to react when those heavily inflated, fundamentally detached prices suddenly come crashing back down to reality. Almost overnight, sudden and violent volatility strikes. You wake up, open your brokerage app, and your entire portfolio has turned a bloody, terrifying red. The visceral feeling of the market turning is physically sickening. The exact same beginners who felt absolutely invincible just a week prior suddenly suffer complete emotional breakdowns. Reality sets in that the brilliant confidence they thought they had, it was actually just rented from the bull market. And that confidence completely evaporates when they have absolutely no idea what to do as a stock they thought was a sure thing drops 30% in a single morning. This is the brutal reality of the market cycle. You see, a crash isn't just a simple drop in prices, it's a vicious, self-feeding cascade of pure fear. Those heavily hyped small-cap stocks that doubled in weeks, they often crash just as fast. Leveraged traders get completely trapped when margin calls force their brokers to automatically sell out their accounts, which in turn drives prices even lower, causing even more panic. Option buyers watch their expensive premiums rapidly become worthless. The entire market transforms from a place of wild, euphoric excitement into a source of severe, paralyzing anxiety. There's a saying that bull markets make people feel smart, but bear markets reveal who is actually disciplined. And that serves as the ultimate reality check for our explainer today. It is incredibly easy to look like a financial genius when absolutely everything goes up, but a devastating crash actually tests your character. The market is an incredibly efficient, unforgiving teacher, and its absolute harshest lessons are strictly taught when prices are falling. Section 5, the disciplined investor mindset and how to go about surviving the cycle. So how exactly do seasoned veterans survive this emotional roller coaster without losing their capital or, their minds? Well, the secret is that experienced investors operate on a completely different psychological frequency. They know euphoric phases never last forever, so they actively prioritize capital protection over temporary hype. While the beginner is constantly chasing excitement in the next hot tip, the disciplined investor understands that boring consistency almost always beats constant excitement over a 10-year horizon. They focus intensely on business valuation, deep fundamental research, and heavily managing their downside risk. They rigorously focus on 4 core pillars. First up, strict asset allocation and diversification, ensuring they never have all their eggs in one highly speculative basket. Second, they focus purely on real business quality and cash flows, rather than just chasing stock price momentum. Third, they deeply trust in the mathematical magic of long-term compounding, knowing that true wealth builds slowly over time. And fourth, they exercise supreme emotional control. In fact, seasoned investors deliberately pull back and become significantly more cautious exactly when the rest of the market is getting overwhelmingly greedy. The absolute main takeaway here is that genuine wealth creation isn't about the constant dopamine rush of a bull market. It's a repetitive, highly disciplined, and remarkably quiet process. In fact, being boring is a feature, not a bug, of good investing. True wealth is built quietly over decades, not overnight on some viral social media trend. It definitely doesn't make for an exciting profit screenshot to share with your friends, but it is the absolute only proven way to actually build lasting financial independence. Remember, the ultimate goal isn't to look incredibly smart during a temporary rally. It's to survive and grow your wealth over multiple decades. You don't have to perfectly outsmart the market. You really just have to outlast your own worst emotions. You don't need to pick the perfect stock at the exact perfect time. You just need the intense emotional resilience to stick to a proven strategy when everyone else around you is completely losing their heads. So, I'll leave you with this. Are you building real wealth with a disciplined strategy, or are you just renting temporary confidence from a bull market? Take a hard, honest look at your own portfolio and ask yourself who you'll be when the tide eventually goes out. Thank you for joining me for this explainer. Stay disciplined and keep learning.